Hey traders, in this video I am going to reveal the exact methods on how to identify strong support and weak support and resistance levels. I'm sure you've experienced this before, where you identify a support level, you enter a buy position and place your stop loss slightly below it, but the price breaks right through your support, hits your stop loss, and then reverses back up. This happens because you are trading weak support levels, and in this video I will show you how to filter those out and only trade the strong ones. First, we need to understand what support and resistance levels actually are. These are key levels that formed horizontally, where the price has bounced off in the past and could possibly bounce again in the future. If the level is below the current price, it is called support, where you can take a buy position, and if it is above the price, it is called resistance, where you can take a sell position. Support and resistance levels require prior rejections to form, meaning if the price rejected a certain level twice in the past, we can draw a horizontal line there. However, not all levels are strong, and the biggest mistake traders make is thinking that the more times a price touches a level, the stronger it gets. In reality, it is the exact opposite. Every time price hits a high-volume support or resistance level, it actually gets weaker, and after it crosses it multiple times, the level starts losing its strength and will eventually break. Furthermore, when a support level looks too obvious, like a double bottom or a triple bottom, a lot of retail traders will enter long positions there and place their stop losses just below it. This causes a massive buildup of liquidity under that level. Professional traders know this, and they will intentionally push the price down to sweep that liquidity and trigger your stop losses to fill their own orders before reversing the price back up. Because of this manipulation, obvious support and resistance levels that have been tested many times are actually weak and are highly dangerous to trade. So how do we find strong support and resistance levels instead? One of the best ways is to look for fresh supply and demand areas, which are often referred to as order blocks. These are zones where significant price movements have occurred because large institutions or smart money entered the market. To find a strong demand level, you simply look for an area where price made a sharp and aggressive move upwards. The initial area right before that aggressive move happened is your strong support zone. The absolute key rule here is that this level must remain unmitigated, meaning the price has not retested or touched it yet. The very first time price retraces back to this fresh level, the probability of a strong bounce is incredibly high because the institutional orders are still sitting there. Another powerful secret to identifying strong supports and resistances is finding an area of confluence. Confluence is when multiple key levels intersect with each other at the exact same price area. For example, you might spot a previous resistance level that was broken and has now turned into a support level. If you look closely and notice that an upwards trend line also intersects exactly at that same support level, you now have a point of confluence. You can even combine this with the Fibonacci retracement tool to see if the golden zone lines line up perfectly with your level. When multiple key levels converge into one single area, it becomes the strongest type of key level, meaning the chance of price rejecting and bouncing off is much higher. But even when you find a strong support or resistance level, you should never blindly take trades just because the price touches it. Strong levels are not magic, and prices can always break right through them if the momentum is strong enough. You must always wait for extra confirmation to ensure that the price is actually rejecting the level. A highly effective way to confirm this is by looking for specific candlestick patterns, like the pin bar. A bullish pin bar has a small body and a long tail sticking out from the bottom, indicating that the rejection came from below. If a bullish pin bar forms right as the price touches your strong area of confluence, it confirms that buyers are actively stepping in. If you want more simple and easy-to-understand trading strategies, or if you want to see how I analyze the markets in real time, make sure to join my free Telegram community. Inside, I share my daily market outlooks and trade setups completely for free. Also, if you found this video helpful, kindly do me a small favor by hitting the like and subscribe button. It literally only takes 2 clicks, but it means so much to me and helps the channel out a ton. Thank you guys so much for watching, and I will see you in the next video.